Hello, and welcome to the session on trade tensions and what they mean for you as a Netwealth client. I'm delighted to be joined here today by Gerard Lyons, our Chief Economic Strategist, and Iain Barnes, our Chief Investment Officer. I'm Simran Kular, and I'm joining you from the marketing team. With markets reeling from Donald Trump's announcement on the 2nd of April, we're here to help you understand what we're doing to navigate these changes. Iain, why don't we jump right in? How bad is the damage?
Well, thanks, Simran. Well, it certainly feels as though equities have been struggling to handle this change of direction from the US government. So far, we have seen some equity market falls, but it's more the day-to-day variation that's been most problematic within markets. Some people refer to measures like the VIX index, which is a traditional gauge of market volatility, and that's been pretty elevated as a symbol of things that are going on. But although we have seen negative returns, the variation isn't really that extreme at all. We've got a slide actually titled Equity Market Volatility, and in this slide we look at the different returns that have been seen over the past 25 years. The navy blue bars are the total market return in any given calendar year, whereas the purple ones show the major drawdowns that we've seen in each position. And you can see that in 18 out of those 25 years, you've seen a drop of more than 10% in markets at any point in time. But also in 18 of those 25 years, you've seen positive market returns. So you should expect to see variation in equity market performance, but that doesn't mean that you're going to see negative returns overall. So nothing so far has been extremely unusual, even if it has been a little bit uncomfortable. The wider context, which I think we'll come on to talk about, is a little bit uncertain and a bit more unusual. What's been happening with other asset classes at the same time? But we can go into that in a bit more detail.
Thank you. That's super interesting. So, Jerry, if that's what's going on with portfolios at the moment, could you tell us, if we consider this like a Richter scale, with 10 being the worst, most economically impactful, and 1 being less impactful, and considering the 2008 financial crash and, COVID, where does this fall on a scale?
Yeah, well, unfortunately, there's lots of earthquakes. The good thing about that, if you can say there's a good thing, is they actually have a scale to measure the strength of earthquakes. Strong earthquake is anything with a 6 on the Richter scale. 6 to 6.9. There's about 100 of those a year, actually, amazingly. Then a major earthquake is 7 plus. There's about 20 of those a year. And then you get a giant earthquake, 8 plus on the Richter scale. And you only get one of those, thankfully, in a sort of once every 5-6 years or so. Now, it's very hard, therefore, to immediately translate a financial or economic hit into that Richter scale, because we don't get that many economic or financial hits. Unfortunately, they've become more frequent in the last few decades, and they've become more impactful. Now, if I was to use the Richter scale, what I would say is the 2 giant financial crisis events that would be 8 plus on the Richter scale would probably be the Wall Street crash, 1929, and the global financial crisis of 2008. If we go the next one down, a major 7 plus, then you could probably put the Latin American debt crisis of 1982 or the Asian financial crisis of 1997, and you could probably put the pandemic in there. It was more, obviously, an impact in terms of people's health. It did have a major economic impact. Its impact on the financial markets was less, but nonetheless still significant. Where would this crisis come? Many people draw an analogy between now and the Nixon crisis of the early 70s, when he took the dollar off the gold standard, and that was the prelude to currencies floating. So I would probably put this as a major. It's not a giant. I remember being heavily involved in the 2008 global financial crisis. I was then at Standard Chartered. We came out as the second most capitalized bank from the crisis. We read it very well. I thought a crisis was inevitable. But I remember being in Washington that October at the time of the IMF and going into meetings at the Fed and the Treasury. and the fear was palpable. This is nothing like that. So this is one of those issues where I think it's going to take some time for the full impact to be seen. In fact, I've put a slide up, maybe if I could show that, to compare this tariff crisis with the last two major real economic financial events, the global financial crisis and the pandemic. And in some respects, each of those, probably like this tariff problem, will have an immediate impact and then the longer lasting one. With the global financial crisis, the longer lasting one was the regulatory pendulum swung from being very light self-regulation to being heavy intrusive regulation in the financial sector. But the immediate impact as a result of that crisis was a global recession. The global economy slowed. If you go to the 2008 global financial crisis, or from that to the pandemic rather, in terms of the pandemic, globalization has in some respects given way to fragmentation. But the real economic legacy of the pandemic was global debt levels really soared to very high levels, which is a potential problem now. In terms of this tariff war, I would say is a combination of two things really coming to the fore already. Policy uncertainty and also passive diversification from the dollar. That means, in my mind, people not actively selling US assets. It's just that international investors are thinking twice and they're putting less of their net new money into the dollar. So dilution in terms of the US holdings and probably very evident in terms of the dollar. So it's not, thankfully, as bad as the 2008 global financial crisis, not as bad as the Wall Street crash, but probably on the par with the Asian financial crisis and some legacy effects, just as we saw after the pandemic.
Great, thank you so much. It's really helpful to contextualize it relative to historic events. So you've touched on the macro effects a bit already, but could you go into a bit more detail about the global economic impact that we've seen over the last few weeks?
Yeah, well, normally good economics is good politics. Tariffs is one of these bizarre areas where the politics and the economics pull in different directions. By that, I mean, good economics is that you don't put tariffs on in the first place. And good economics is that you don't retaliate with tariffs with beggar my neighbor policies. The politics, though, as we're seeing with President Trump, in his mind, justifies tariffs. And the politics elsewhere with one or two countries, including China, is to retaliate with higher tariffs. Now, whichever economy one looks at, whether it's America, Britain, China, the outlook depends on the interaction between economic fundamentals, policy, and confidence. And the most difficult thing to predict is confidence. If people lose confidence, if companies lose confidence, people stop spending, companies stop investing. The challenge about this tariff war is the uncertainty has certainly already led to a loss of confidence. In terms of the economic impact, tariffs are likely to lead to an increase in the price level, not necessarily inflation, in the US. So people are worried about the price impact, the longer term inflation consequence maybe, and what that means for the ability for the American Fed to cut interest rates. If tariffs are permanent, or if the temporary pause, etc., doesn't prove to be temporary, then global trade starts to be hit and global growth starts to be hit. And when you have the two biggest economies in the world, America and China, in a trade war, then that clearly has some negative consequences, not just for those two countries, but for others who are open, like the UK or Southeast Asia.
Yes, and that's not the first time Trump has U-turned on these policies, including his pause for electronics. So what do you think is really driving these policies?
Well, I'm sure everyone has their own read on the situation. The way I would interpret it is that President Trump is now having 4 policy resets. 2 have been domestic and 2 have been global. The 2 domestic resets have been in terms of immigration and energy policy, although that latter clearly has some global consequences as well. The 2 major international resets have been in terms of defense and now in terms of trade. The defense reset we've started to become used to in the last 4, 5, 6 weeks, in the sense that we've already in markets and economic terms started to factor that into planning and to thinking that defense budgets will rise, particularly in Western Europe, including the UK. This trade reset is a major worry. Now, what's underpinning it? In his first term, President Trump did have some targeted tariffs. They were linked in the terms of the time to fair trade. a focus very much on China and one or two other countries. This time, however, as we've seen, the tariff hit has been comprehensive and it's been deep. And that's why markets were taken aback. They expected the tariff hit to be more targeted again. And it seems to be, from what I can determine, that there have been three contributing factors to this for President Trump. One has been a revenue-raising component to then fund tax cuts in the States. Second is what should we call it, a disciplinarian approach, non-economic, hitting Canada or Mexico with higher tariffs because of non-economic reasons linked to migration or drugs, say. And then the third component has been about addressing imbalances in global trade. Now, because of those different impacts on the revenue-raising side, I'm sure there are people in President Trump's ear saying, keep the tariffs on, we need the revenues. On the other side, people are saying the distortion to global trade is really impacting because supply chains are so intertwined. And hence, as we saw last week, the electronics reversal. So it's all up in the air. One would argue the spin, shall we say, is to say this is about transactional, this is about encouraging other countries to come and do trade deals. But it adds to the uncertainty. But there's many different components, but it's a significantly different approach to his first term when it was a very targeted fair trade element to the tariffs. This time it's more comprehensive, more deep and more disruptive.
And how would you say global governments are reacting to these changes?
Well, the good economics would say don't reply with higher tariffs, but it becomes very difficult. Look, as we've seen with China, they've already responded with a significant increase in tariffs. Excuse me. In his first term, when President Trump hit China with tariffs, the Chinese responded not with tariffs. They responded with what was called a dual circulation policy. And they moved towards self-sufficiency in food, energy and technology. This time around, we're seeing those countries hit hardest, like China, responding. Other countries seem to be somewhere in between, waiting to see how the land lies. And the EU-US relationship, excuse me, may not turn out too good. But other countries like the UK are trying to do a trade deal.
Yeah. A lot of the financial media especially are saying that China's faring better than the US is, given the current situation. What would you say about that? Do you think it's even possible to predict?
No, it's not possible to predict. In quantitative terms, it's hard to say, partly because there are so many things up in the air. In qualitative terms, we can get a guide. What the Chinese will likely do is focus both on a reorientation of their trade and a boost to their domestic economy. In terms of trade, it's about seeking out new markets or expanding their growth into existing markets. For instance, this week, President Xi Jinping is in Vietnam, Malaysia and Cambodia. The Premier of China was in Southeast Asia with ASEAN back last November, the week of or around the time of the US election. Redirecting exports to the States via Vietnam was a common theme in the first term. Maybe China might even open up some parts of their domestic economy. But in terms of the domestic economy, it will be about targeted fiscal policy and it will be about unconventional monetary policy. An important thing in all of this, while we can all worry and the headlines in the media are that this is terrible, part of the reason why markets, as Iain touched on, are not crashing. Obviously, bond markets are different to equity markets, but bond markets are anticipating a policy reaction. They're not just wondering and double guessing about how President Trump will move on future tariff policy. They're anticipating countries, including the US, but certainly elsewhere, using monetary and fiscal policy where possible and where appropriate to stimulate their domestic economies.
Speaking of domestic economies, let's bring it to the UK now.
Yeah.
The OBR gave 3 situations that can result from the US tariffs. And one of them actually predicted a 1% reduction and a significant reduction in the UK's fiscal buffer. We've got people talking about recession, stagflation.
Yeah.
How worried should we be?
Well, people talk about anything at the moment. It seems pick up the sort of acronym or pick up a new economic term. Here in the UK, the challenge last year was that the UK was hit in the middle of the year by an election. And it usually doesn't matter in the UK who might win power. Whenever an election comes along, it tends to lead to a temporary lull in the economy. What we unfortunately saw last year in the UK was the first half of the year, whilst it was strong, that did not continue into the second half of the year. Normally, a new government gets their new budget out of the way. Because the new Chancellor, Rachel Reeves, wanted to have the OBR signing things off. She wanted to avoid any repetition of the mini budget. That meant that the budget didn't come until 10 or 11 weeks after the election. So suddenly everyone not only put things on hold at the time of the election, they then kept things on hold until the budget came along. Then, unfortunately, the budget hit us hard with higher taxes on employment, and that led to the corporate sector adjusting. So second half of last year was not too good, but we had some very good UK GDP growth figures in second month of this year, just out earlier this week. And even though the surveys have been cautious in the UK, one of the points we've made at Netwealth is that if you look at the underlying message, whether it's companies or consumers, they're actually far more positive about their own situation than they are about the wider economic outlook, which would suggest that people might have a bit more room for manoeuvre. And indeed, in Britain, wages are rising at more than the rate of inflation. Inflation in latest data out today dipped again down to 2.6. So there's real income gains. So as bad as the press would like to make everything sound, the UK might have a bit more resilience. But you touched on the key thing. The OBR in the spring statement said that if there were tariffs, then they would have a hit. And depending on the scale of the tariffs. So obviously this is even worse than their worst case. So if the full tariff impact of it impacts or follows through, then the UK will suffer. Now, the direct impact for Britain is limited because we're primarily a service sector economy, one of the two biggest in the world. Services have not been hit by tariffs. Our trade with the US is more or less in balance. Car exports to the States, unfortunately, have been hit with a high tariff, but there might be a trade deal. You don't need the trade deal to trade, but the direct impact might be relatively limited. The indirect or the second round impact for Britain is significant, which is what the OBR would be talking about, which is because we're a large open economy, if global trade slows and global growth slows, then that takes some of the shine off the UK. And the government doesn't have any room for fiscal manoeuvre. And indeed, because of the fiscal rules, they might be tempted to raise taxes, which is a pro-cyclical fiscal policy, which quite frankly is stupid. It's like being in the hole and digging deeper. But thankfully in the UK, with inflation coming down, the Bank of England has the ability to cut interest rates. UK interest rates are 4.5%. Our long-held view has been that they would fall to at least 4%. And if they weren't at 4% by the autumn, they would be more likely to be at 3.5% than 4.5%. Notwithstanding the uncertainty about tariffs and the uncertainty about their impact on US prices, not on UK prices, the Bank of England will be cutting rates.
Very interesting. And we're talking a lot about deglobalization.
Yeah.
You spoke there about how the world is responding and the kind of moves that the UK can make there. What do you think deglobalization or fragmentation would mean for this quote unquote new world order for long-term growth?
Yeah, look, there are many different moving parts in this. One of the important things, as Iain might well touch on later, is that in our portfolios, we're diversified and we're global. And there are some underlying shifts underway. And the tariffs, in some respects, are a response to these underlying shifts. Trade has not, unfortunately, been completely fair. Germany, China, Japan, and Saudi Arabia were all highlighted back in 2006 by the IMF as the four countries stroke regions that needed to be spending more to get their surpluses down. And the people who've suffered as a result of globalization have been the low-skilled or previously in safe manufacturing jobs as well in the West. The people that President Trump was referring to when he delivered his tariff statement the other week. And he held up a book, which is an annual book that the US produces. And sadly, I have looked at this book a few times. It's about 398 pages. It's not bedtime. Well, if you want to go to sleep, it's good bedtime reading. But what's frightening in it is how it's remained pretty unchanged in many of these countries. It's not priced in tariffs. It's non-price tariffs, regulatory burdens. So President Trump didn't go about things in the right way. I disagree with tariffs, but he's addressing an underlying issue, which comes directly to your question about globalization and deglobalization. Earlier, I showed a slide about the pandemic. After the pandemic, the saying was that we've gone from globalization to fragmentation. If you want to be negative, now you could say globalization to fragmentation, free trade to protectionism, and countries are now, or governments in Western economies, are now putting national security alongside economic prosperity as central in their economic thinking. That means that you have a distortion and a change. But at the same time, some key drivers of globalization are still there. The very fact that President Trump has had to backtrack on part of his tariff policy is that when you look at an iPhone, it comes from 40 different countries. That is not going to change overnight. So globalization, I wrote a book on this called The Consolations of Economics about 10, 12 years ago. I said there were 4 global drivers: hard power, defense, that's still there; soft power and creativity, ability to influence, that's there more than ever now; institutional power is still global. The IMF, the United Nations, these institutions may well change. And economic and financial power. Now, climate change and demographics are key global factors, regardless of what President Trump will say. But there will be other changes. And as I said earlier, the reset on trade is hard to predict.
Yeah.
And if it goes from globalization to fragmentation, it's more a dilution of globalization rather than deglobalization.
Thank you. Let's turn now to markets more specifically, Iain. In times of turbulence like this, often we see a flock to bond markets. Is that what we've seen now? Is the behavior the same, or what's going on?
Well, I think that really speaks to the nature of the uncertainty around this crisis that we're seeing at the moment. So you're right that historically, usually when there is uncertainty, the predictability of bond market returns are more valued by investors. So the certainty of the cash flows that owning bonds produces. There are, however, nuances to it. So historically, we've thought more about scares on growth, which is where a steady income provided by fixed income, as the name suggests, it becomes more highly valued. When the scare is more about inflation, as we saw in the past couple of years, the validity of holding bonds gets called into question. And that's where our other diversifying assets within portfolios really came to the fore. The interesting part about the moment is people really aren't sure about how these policies are going to impact global growth, and the US in particular. And it's the US market that, of course, has been at in focus. When we spoke about equity market volatility historically, just earlier in the conversation, we showed the returns denominated in dollars. Now, usually, the exposure to the US acts as a dampener of the volatility, either through the quality of its equity market or through exposure to the dollar. Fixed income often works in the same way. But what you're seeing at the moment is the dollar has depreciated and people are less sure about holding US assets as a whole. And the treasury market has been caught up in that. Now, we do have another slide that we can show, please, showing the asset class performance so far this year. And the interesting thing to us is that after the inflationary scare of the past couple of years, you're actually seeing reasonably attractive real yields in fixed income. So they're showing that means that you're getting a positive return after inflation has been taken into account. So if you look towards the middle of this chart, which shows the returns on so far this year and on a year-to-date basis, even though you've seen a bit of volatility in the returns from UK bonds, so gilts, but also US treasuries, they've actually been eking out a positive positive return. It's the way that the market has behaved at points of volatility that has started to concern people. Now, people are trying to think about what the trigger for that has been. People are suggesting that you're going to see more of this passive diversification that Jerry was talking about. Other people think it's an impact of broader investors deleveraging portfolios, selling what they are able to. And in other instances, it's more particular to concerns about the quality of the issuer, so of the US government. What it isn't about at the moment is inflation concerns. Initially, people spoke about worries about inflation from tariffs. I think Jerry's right that it's likely to be more of a one-off sort of price reset rather than ongoing inflationary trigger. But you haven't seen expectations for inflation or measures by which you protect yourself from inflation changing much through the course of this year. So it's really just been caught up, I think, in the narrative in the immediate time of what is going on more broadly. But you can see on the left hand side, we look at equity market returns again, and you can see that there's been a bit of variation. Unusually, the US is underperforming at that point, and we can talk about that in a bit more detail perhaps later on. Bond markets have been okay. The UK and continental Europe have had a bit more positive experience. The real winner over to the right hand side of the slide has been gold, and that's the beneficiary of where you're talking about people seeking safe havens. People's perception of the value of gold as an asset has undoubtedly appreciated right now as a protection against a broader uncertainty, as well as expectations of what big sovereign holders of US treasuries have been doing, namely Asian countries, whether it be China or Japan. What are they going to do if they no longer want to hold as much US debt? That's why gold has been improving.
Yeah. Just if I could come in there, it's fascinating. Yeah, the US has a huge budget deficit. And in fact, the good, the bad, and the uncertain about President Trump, we said at the beginning of the year, was the good would be if he did follow through on his domestic policies to cut taxes and ease regulation. The markets were rallying on that. The bad was the tariffs, and the uncertainty is the budget deficit. But when it comes to US national debt, 22.9% is owned by foreign central banks. The Japanese, $1 trillion, the Chinese, 800 billion. But it's not in their best interest at the moment to sell US assets. It's almost their trump card, to use that word, that they can hold back if they want to have it in tariff negotiation. But the markets have reacted to that. They've sort of factored that into some of their thinking. Yeah.
But again, it's not always a sort of consistent response from markets through time. So at points in time, we've seen the gilt market, so UK government bonds, also getting caught between the crosshairs as the market likes to focus on issuers with fiscal challenges, and people think that maybe the UK might get caught in that. So as we saw the dollar sold off, sterling wasn't able to participate initially in as much of the rally as maybe some other safe haven currencies were able to, and gilts underperformed a little bit more. As you're seeing the market stabilize, and we think that the market is stabilized because it saw that it got a reaction out of the US administration, but you started to see gilts perform pretty well. Sterling has started to pick up again, and it's had a bit of a tailwind, of course, from some of the good news that we've seen from the UK coming out in the past few days, which has all helped as well.
If I may, I think that point is very important for viewers, that when you have these sorts of shocks, and you touched on the volatility, markets can react in quite significant ways. And the fear is that will continue. If you take fixed income markets, investors had viewed them as a safe haven even before this crisis. And there have been what is best called crowded trades. It's called the basis trade. So many investors and hedge funds, etc., had these trades on because they thought it was predictable. Suddenly you have this shock, and then they have to sell their fixed income to get liquidity to cover their collateral on other trades. So you have that distorted impact reinforcing the other worries about inflation, about potential foreign selling. So then it takes a little while for those trades to almost work their way through the system. And then the markets, I won't say calm down, but it's a bit more reassuring, shall we say, as we move ahead.
Yeah, definitely.
Sorry,
very interesting to see how safe haven assets are performing with the current market volatility. But the said volatility has come at a time where a lot of clients are looking to maybe withdraw earlier than anticipated, given the recent changes to tax allowances and pension rules. So, Iain, do you have any recommendations or suggestions for clients on how to handle that?
Yes, so it's something that we've been engaging with a lot of clients about already. A lot of people, as you suggest, have been taking sensible steps about readjusting their plans, particularly around pensions, given the change of legislation and tax rules. Now, my starting point from an investment point of view is to say that, really the market volatility today, again, just going back to those early slides, some of the daily moves have been pretty dramatic, but it's not out with normal expectations of how markets can operate. We know that periodically they do go through episodes like this. The most important thing, of course, is that people have the right risk level exposure for their longer term gains. So that if you are anticipating some changes coming up, you can adjust portfolios in the knowledge that not that much will have changed. It's an unfortunate pinch point whereby some of the legislation changes have come at a point when you're seeing a little bit more variation in returns. Here, when thinking about these big decisions, we should always encourage clients to get in touch with the advice team so that they can formulate a plan on a specific basis to think about, what are the timeframes that are required? What are any other factors that need to be taken into consideration? So it's one of those questions that are really important, but has to be unique to the individual client.
Very interesting. It would be helpful if you could let us know how you're responding to the current turbulence in the market. Are you making changes to portfolio allocations?
Yes. So this really hits to the heart of what we're doing on a day-to-day basis. I think it's important at times like this just to take the opportunity to step back a little bit and think about the way that we as an investment team look to build client portfolios and their exposures through time. So if we think about the Netwealth approach, all of the portfolio allocations are driven by more strategic or long-term views about how asset classes should behave and how we expect them to behave, and then more cyclical, shorter-term considerations. And it's the interaction of those two moving parts that really culminates in the portfolio weights. So earlier in the year, we made some changes on a strategic basis to portfolios, and that's driven by our long-term expectations for capital market returns. Now, of course, the excitement that we've seen in the past couple of months there has been a prelude to this because the election was in November, and as Jerry mentioned, we knew that there were going to be good, bad, and uncertain parts to the Trump administration. So earlier in the year, we decided that given the backdrop to the UK market and some of the challenges that could be seen with the incoming government failing to take the opportunity to drive a bit further ahead on their mandate for growth as they saw it. We saw some sluggish performance from on an earnings basis from the UK market, and thought it made sense to diversify into a broader market exposure. So adding to Europe, to emerging markets, a little bit to Japan, and also to the US. So the US is an important part of portfolios. And I think at the moment now, it's forcing investors, not just us, to reconsider what you're looking for from that market exposure. Now, from our point of view, we take valuations pretty seriously. We think they're an important driver of long-term asset class performance. And we've spoken about it many times before, but the concern about the US is that there's a small group of very significant stocks that are trading at very significant valuations. That's the cohort of consumer technology facing names that we're all familiar with. So when thinking about the exposure to the US, really at the heart of this episode of volatility, we need to try and pick that apart a little bit. So we didn't want to add to the mega cap companies. We added to broader market exposure and including a little bit to medium-sized companies where we felt the valuations were more attractive and still benefited from some of the structural advantages that the US has displayed over the past few years. And that dynamic is where we're really trying to pick things apart at the moment. People ask about whether you should be buying the dip in the US market, or if we should be I saw an incredible headline recently asking whether the US is investable at all under the current administration. So you have two real differences in opinions, and the outcomes could be significant. For us, the concern is how you can make a reasonable forecast about what the earnings profile of corporate America is going to look like in the coming quarters and years ahead, when so much is being driven, as Jerry was mentioning, by some very loosely held policy decisions. We've seen some of the flip-flopping around how some of the tariffs get structured, and obviously it's all dependent on the responses from other countries as well. So our response at the moment is to say, okay, if consensus for earnings growth is about 10% coming into this period, we're pretty sure that it's not going to be 10% earnings growth across the US market in the current conditions. Even if even more of the tariffs are walked back, we know that that is where the real goals of the administration lie. So we think there is going to be a hit to earnings. Now, if you think that the bulk of the market was priced reasonably expensively, not egregiously, but reasonably expensively, if the earnings fall a little bit from where consensus lies, then we think that obviously makes the underlying assets a little bit more expensive. We don't think that earnings are going to turn into negative territory. It's not our base case that we see a recession in the US. We think there is going to be more of a slowdown, but it's very hard to predict. If we do see a recession in the US, then the market isn't priced there, and we'll need to respond to that. So that's a long bit of backdrop about the US picture. I think what we have to be clear on is that we have to have confidence in the way that the portfolios were set up heading into this period of volatility, though, having different drivers of performance within portfolios that we can then benefit from. So I mentioned the incorporation of cyclical positions into portfolios. We have 2 cyclical positions at the moment which were designed specifically to be a little bit more defensive. The first one is to remove corporate bond exposure from portfolios. Initially, we started with low quality corporate bonds, and then also reduced our exposure to the higher quality corporate bond market because we didn't think that you were getting paid for that extra component of risk. It's been quite interesting to see how that part of the bond market has started to respond when there was a lot more uncertainty developing. And we've also added some euro exposure to portfolios. Now, historically, we haven't had big positions in the euro. It's been the right position to hold, everything on a hedged basis back to sterling. But that position has also been working out well. Now, when we think about whether we're making any changes, we had our formal investment committee yesterday. Of course, have been talking as a group over the past days to think about what we're doing. At the moment, we're pretty happy with the way that the portfolios are set up to deal with the circumstances as we see them as they are now. Now, we're not going to make dramatic changes to portfolios based on today's interpretation of where the tariff policies are going to lie in the coming weeks or maybe months, because it's just too hard to do that. We do recognize, though, that we're going to have to be a little bit more responsive and ready to make different changes as and when needed. So one instance is last week at a point of volatility, we took the decision to rebalance all portfolios. So we reset our positioning back to targets, buying a bit more into those assets that have fallen, and just trimming exposure. And so that's added incremental value to date to portfolios. And in addition to some of the cyclical positioning, we think that's been pretty additive to client portfolios so far. But it's something that's got to be monitored on a day-to-day basis.
Yeah, and I would like both of your inputs for this next question, which is there's been loads of talk of a trade deal, and I want to know what would that mean for both the challenges on a macro level and also for markets and how you'd invest.
You mean a UK-US trade
yes.
deal? Yeah, well, you don't need a trade deal to trade. Most people get confused by this. US is the biggest single economy with which the UK trades. And as we touched on earlier, a lot of the focus in the US has been on, well, has all been on goods. And the UK is a service sector economy. Obviously, it depends on the relationship with the EU as well. People can make up their own mind on the politics of that. But if Britain stays outside the EU single market, then it gives Britain a lot of room of regulatory manoeuvre in the area of AI. And if Britain stays outside the EU's customs union, then the argument would it gives Britain lots of chance to not only do a trade deal with the States, but with other countries. One of the things in the press this morning, of course, is that the Prime Minister wants to resolve this issue between Northern Ireland and other parts of the UK. Mm-hmm. But if he does that, then it ties us more into the EU on some regulatory issues which might have consequences. So the politicians have to move many moving parts. But if the markets just look at it solely in terms of US, UK, then the markets will take the view that any trade deal is a relatively good thing. But I think in the broader picture, the uncertainty is the worry. And even if Britain benefits or is not that badly impacted directly, indirectly as an open economy, we all are impacted by global trade if it slows.
Yeah. Iain, would anything change about what you said regarding investment strategies should a trade deal be reached in the UK?
I think when it's probably more important on the fixed income side than on equities, I would say. At the margin, I think it would probably be a bit more favourable for UK equities as a whole, but possibly work in favour of our small and medium-sized companies rather than the FTSE 100, which tends to be more driven by its the makeup of its sector exposures more than anything.
Perfect. I think now would be a good time to go over the key takeaways. And I believe you've got a slide, Iain, to show the audience.
Yeah, so from a market and portfolio takeaway point of view, I think the thing we want to reassure our clients about is that we recognise that the market volatility has been a little bit uncomfortable, but levels aren't that unheard of at the moment. We have to maintain a focus and just see how the situation develops before making any more major changes. The second thing is that portfolios are performing broadly in line with how we would expect them to, given the market backdrop. There are a number of different moving parts within all of the Netwealth portfolios, and we've been certainly pleasantly surprised by, say, the performance of gold over this period. We've been surprised at the level of volatility within some of the fixed income markets, but recognize that over the whole of this episode, they have eked out a positive return and are still impressed by that positive real yield that you can recoup over year by year. I think the third point that we spent a bit of time discussing really is that US assets are under pressure. You have to recognize that. I think the challenge that markets and ourselves are really trying to get to grips with is to recognize whether this is more of a cyclical issue or something that is more structural in essence. And I think that will only become clear over time. And we're happy with the broad regional mix within our equity market exposure that is more diversified than just a naive market cap global equity mandate. And then finally, we're sticking to the day job of just making sure that we understand the relationship between the different asset classes, if everything is behaving as it should. And then once markets have settled down a little bit, we'll see if there are any big dislocations within pricing that we think that we can take advantage of over the coming quarters and years to come.
Perfect. And Jerry, what would your key takeaways be?
Key takeaway, I might actually mention one or two new things as well. But look, at the beginning we talked about shocks, and the worry is that when you're facing the shock in front of you, you think this is really, really bad news. And in no way, shape or form should people underestimate the challenges there are. But what's quite remarkable is that given that we've had a global financial crisis, given we've had a pandemic, if you step back and look at the size of the world economy, it trends up. Beginning of this century, the world economy was $32 trillion in size. The day the financial crisis started in 2008, it was $62 trillion in size. This year, the world economy had already sailed through $100 trillion in size. It will take a hit because of the uncertainty, but let's not forget that the trend is for the world economy to do well. Challenge, of course, is different parts of it are going to do better than others, hence the benefit of a globalized, diversified portfolio. If we take fiscal policy, partly because of the pandemic, we went into this latest crisis with debt levels being at very high levels in the West, including the UK. And the real difficulty for the Chancellor, but indeed for any country in the Western world at the moment, when you have high debt levels, if your growth rate is seen as being lower than your rate of interest, then you basically have five choices. You grow, you reform your public sector, you tax, you have austerity, or you borrow. Here in the UK, growth might be sluggish, reform takes some time to feed through, hence the markets are focusing on that combination of austerity, i.e. controlling public spending, taxes, or borrowing. So that challenge shouldn't be underestimated. And then we have the interest rate picture. The Federal Reserve in the States will probably be more cautious, but they'll still cut rates. The Bank of England will cut rates. So there's a sort of shock absorber impact there. And safe havens. Look, if people think the dollar safe haven is changing, that doesn't mean it's a sign of terrible times ahead. It's a reflection of the dynamism in markets. 25 years ago, the safe haven was not the dollar. It was the Deutschmark before the euro, the Swiss franc, and even the Japanese yen and government bonds. So markets adjust. The thing about markets adjusting is that at the time of the adjustment, there's lots of uncertainty. And unfortunately, President Trump, in his reset, has instilled a lot of economic and policy uncertainty, and that's reinforcing the market uncertainty. So you try and need to sort of have a stable hand on the tiller, so to speak. We shouldn't underestimate the challenges, but at the same time, trying to put them in perspective. There are, from the past, lessons, whether it's history, theory, or economic models. Tariffs aren't good, but we have the ability for policy elsewhere to react, and markets maybe, after a few hits, to adjust. So don't panic is probably the message and the takeaway.
Absolutely. Don't panic is a brilliant message to end on. Thank you, Iain and Jerry. That was a really helpful session. And as ever, if you want any advice or have any questions about your portfolio or just want to review your investment approach, please don't hesitate to get in touch at advice@netwealth.com. We'll speak to you soon.